best practices for consolidating your debt. To begin, we're going to start with what is debt consolidation. Debt consolidation, as the name suggests, is a debt solution that will allow you to combine your multiple debts into one simple payment plan. This is meant to make your payments easier. So instead of monitoring various debts and making sure you meet the minimum payments and the due dates at different times, you're going to consolidate those payments into one monthly payment. Debt consolidation puts your debts into one payment plan with one monthly due date, one interest rate, and typically a lower monthly payment. If you found yourself with an unmanageable amount of debt and are struggling to keep everything straight, debt consolidation may be a financial solution for you. Now that we have a basic understanding of what debt consolidation is, you may be thinking, what debt can I consolidate? So in looking into consolidating your debt, you're able to consolidate debt that does not have collateral. Debt that does not have collateral is going to be your store cards, gas cards, credit cards, unsecured personal loans, and student loans. Secured and unsecured loans are the most common types of loans the average person will use throughout their life. It is important to understand how these two types of loans work to help you better understand your own financial portfolio, which is important to be aware of when it comes to consolidating your debt. A secured loan is one protected by an asset used as collateral. In case the borrower defaults on the loan, this item acts as collateral, can be the item you are taking the loan out to purchase, like a car or a home. Auto loans and mortgages are the most common secured loans. The lender will then place a lien on the title of the car or the deed of the home until the loan is paid in full, including your interest. Secured loans are generally for larger amounts of money because the collateral offsets the risk to the lender that the borrower won't make the loan payments. If payments stop, the lender can repossess the car, home, or other assets put up as collateral and use it, usually by selling it, to recoup the money that was lost through the outstanding loan balance. Home equity loans or lines of credit are also considered secured loans because they use the amount of home equity as collateral. The home equity is the current market value of the home minus the amount that is still owed. Like a mortgage, failure to make payments on this type of loan can result in loss of the home. Other assets like ATVs, campers, or trailers can also be used to secure a loan. In general, because secured loans are lower risk, they're going to have lower interest rates, higher borrowing limits, longer repayment periods, and this is all going to be based on the value of the collateral. If a borrower has limited credit history or is rebuilding their credit, lenders may consider them for a secured loan over an unsecured loan. An unsecured loan is not protected by any collateral, meaning if the loan defaults, the lender does not have any property to reclaim and sell. The most common unsecured loans are credit cards, student loans, personal or signature loans, and some home improvement loans. Interest rates on these types of loans are typically higher because there is a greater risk to the lender. So you may be thinking, where do I start with debt consolidation? The first step to an easy and effective debt consolidation is to understand your unique debt situation before you do anything else. After all, you need to know the problem thoroughly before you can hope to solve it. How can you choose the right solution if you do not have the complete understanding of what you are trying to solve? There are a couple of things that you need to pay attention to when you are analyzing your current debt situation. You're going to need to take a look at your balance. This is probably the most important one. How much do you really owe? Take note that your current balance is usually influenced by a lot of things like interest rates. For instance, your credit card balances will increase if you fail to pay in full by the end of a billing cycle. This is why you should stay aware of your balance and make sure that it is current. Otherwise, your plans may not be accurate. You'll need to take a look at your interest rates. This is the most influential part of your debt. It can dictate how fast your balance will grow over the repayment period. If you will consolidate your debts, you should determine the average interest rate of your multiple debts. That way, you know the interest rate that you should target for when you are consolidating your credit accounts to ensure that you are in fact decreasing the rate. Take a look at your due dates. Some people stop paying their debts as soon as they decide to consolidate it, and this is going to be the wrong move. You need to continue meeting your payments until your consolidation strategy is approved. Otherwise, you will incur late payment fees, and that can compromise the balance that you currently owe. So unless you get confirmation that the consolidation is pushing through, continue meeting your payment obligations with your original creditors and lenders. Your credit terms. Finally, you're going to need to take note of the terms of your credit accounts. You need to find out if there's any prepayment penalties on your account. That can be a problem when you consolidate your debt. The consolidation will involve paying all of your multiple debts through the loan or new account that you will open. This means you'll be charged with a prepayment penalty if it is applicable. Once you have a clear understanding of your debts, you can proceed to the next step. Step 2, you will need to take a closer look at your finances so you know how much you can afford to pay on the consolidated debt. You're going to take a look at your income. So start with your income because this is where you will get the funds to pay off your debts. You need to get the total amount of what you really earn each month. If you're earning an irregular income, you need to base your calculations on the lowest income that you may earn. When you base it on the highest, you might fall short one month. Your expenses. After looking at your income, you need to check all of your expenses. Take out all of the debt payments because that will end up being consolidated later on. You need to only get the expenses that you need to survive. Make sure that you allot a budget for your entertainment expenses because you also need to spend some money on some fun activities. Otherwise, you might feel your budget to be very restricting. When setting your budget, be realistic and practical when you're choosing the expenses that you have listed down. Once this step is complete, you can deduct the expenses from your income to determine your disposable income. This is the amount that you can use to pay off your debts. Your source of income. After calculating your disposable income, you should take a look at your source of finances first. You want to make sure that this source is stable and steady. If there's a chance that your source of income can be compromised in the future, that will influence how much disposable income you have allocated towards your debt payments. If your income is not stable, you need to allocate only 70% of your disposable income. The rest should be put aside for times when you feel like your income cannot support all the expenses and debt payments that you have to pay each month. In your emergency fund. Finally, you need to take a look at your emergency fund. If you do not have this fund, you need to avoid committing most of your disposable income to your debt payments. You need to first give this fund a boost. This reserve fund will help you out of tight financial spots in the future and will keep you from compromising your debt payments. While you are encouraged to pay as much as you can towards your debts, do not commit 100% of your disposable income towards your debt payments. You may want to allocate a lower percentage so you have a buffer left on your budget. After taking a closer look at your current finances, identify your financial goals for after consolidating debt. The reason why you need to think about your goals is because you want to make sure it will not be compromised after you have consolidated your debts. Most of the options to consolidate debt will have an effect on your credit score. For example, if you have multiple inquiries in a short period of time, it may cause a dip in your credit score. And this could impact your financial goal of purchasing a home or taking out a larger loan. So these are things to keep in mind when you are thinking about consolidating your debt. And then the next step is to research your options. Now that we have a clearer understanding of your finances, it's important to know what debt consolidation options are available and what ones are right for you. There are several ways that you can lump your debts together by consolidating them into a single payment. So here are a few of the most common. A debt consolidation loan. If you find it difficult to manage the number or the size of your outstanding debts, consider a debt consolidation loan. Here at Health Advantage, we're a credit union that understands life can get a little messy. So talk with one of our credit union experts about our debt consolidation loan and take advantage of our great low rate of 5.9%. Another option for consolidating debt, if you have multiple credit card payments, is a balance transfer. We know credit card debt can be overwhelming, so we offer Visa balance transfers for a great low rate of 5.9% for the life of the balance and no transfer fees. Take advantage of our Visa balance transfer and enjoy one low payment for all of your credit card needs. HELOCs, or home equity line of credits, are also an option for consolidating your debt. You can use your home's equity for your loan and use the funds to pay off high-rate credit cards and loans. And then there are various student loan programs out there where they can get your new interest rate, which would be weighted off the average of your previous loans. So if you're considering a debt consolidation loan, there are advantages and disadvantages to think of. Advantages would be debt consolidation can be a great tool for people who have multiple debts with high interest rates or monthly payments, especially for those who owe $10,000 or more. By negotiating one of these loans, you can benefit from a single monthly payment in lieu of multiple payments, and not to mention a lower interest rate. And as long as you don't take out any additional debt, you can look forward to becoming debt-free sooner. Going through the debt consolidation process can cut down calls or letters from collection agencies, provided the new loan is kept up to date. Some disadvantages: although the interest rate and monthly payment may be lower on a debt consolidation loan, it is important to pay attention to the payment schedule. Longer payment schedules, meaning paying more in the long run, if you consider consolidation loans. Speak to your credit card issuers to find out how long it will take to pay off debts at their current interest rate and compare that to the potential new loan. There's also the potential loss of special provisions on school debt, such as interest rate discounts and other rebates. Consolidating debt can cause these provisions to disappear. So how does debt consolidation affect my credit score? A consolidation loan may help your credit score down the road. Paying off the loan's principal portion sooner can keep interest payments low, which means less money out of your pocket. So this in turn can help boost your credit score, making you more attractive to future creditors. At the same time, rolling over existing loans into a brand new one may initially have a negative impact on your credit score. That's because credit scores favor longer standing debts with longer, more consistent payment histories. Also, closing out old credit accounts and opening a single new one may reduce the total amount of credit available, raising your debt to credit utilization ratio. So what are some requirements for debt consolidation? Borrowers must have income and creditworthiness necessary to qualify, especially if you're going to a lender that you have not dealt with before. Although the kind of documentation you'll need often depends on your credit history, the most common pieces of information include your most recent pay stub for each credit card or loan you wish to pay off, the letters from creditors or repayment agencies. Once you get your debt consolidation plan in place, you should consider who you're going to pay off first. In a lot of cases, this may be decided by your lender, who may choose the order in which creditors are repaid based on the amount of the loan. However, if you have a lower interest loan that is causing you more emotional and mental stress than a higher interest one, such as a personal loan that has strained family relations, you may want to start with that one instead. This is a warning to keep in mind when you are freeing up your credit card debt. Make sure you aren't turning around and using those cards. By using the cards you just paid off with your debt consolidation loan, you're going to end up doubling the amount of debt that you're in. It's typically your responsibility to take the money loaned and pay off the lender. You may have the choice to keep your credit card open if you're using your consolidation loan towards paying off the balance. By keeping it open, it will help with the length of your credit history. Just be sure to use the card with caution to avoid racking up a high balance. When it comes to paying some of your debts, start with your smallest first and use the snowball effect to pay off the remainder. With the snowball effect, you'll begin with paying the most towards your smallest loan while paying the minimum to any others. Then, once one is fully paid, move on to your next lowest, and so on. So for a recap, we offer a few different options when it comes to consolidating your debt. For the month of January, we're offering great low rates on our debt consolidation and Visa balance transfers. If you're interested in learning more about our consolidating your debt this new year, our credit union experts are eager to help you achieve your financial goals and are ready to help with whatever financial situation you may be in. So thank you for joining us today for this webinar on debt consolidation. I hope you learned a few things and found it helpful. This webinar is recorded, so you will get an email with a recorded presentation following this presentation. I'll now take this time to answer a few questions that you may have. If you have any questions, feel free to type them in the chat box. All right, it looks like we have a question. It states, why would I want to pay the smallest first instead of one with the highest interest? That's a great question, Dennis. Typically, they suggest that you start with your smallest first, so that way you can start to get rid of that debt. But rather than the highest interest, I would have to check with one of our loan experts and get back to you on that one. I will make sure to reach out to you if you want to send in your information. I can send you an email with the correct answer on why you might not want to start with the highest interest. I'll stay on here for a little bit longer, see if anyone else has any questions. And again, Dennis, if you want to send me your information, I'll be happy to reach back out to you with that info.
I have a question. Can you hear me?
Yes, I can.
Oh, good. Well, my question is this: rather than pay off the lowest or the lowest loan first, I have been doing, if I have multiple credit cards with different expiration dates, I've been paying off the first one with the closest expiration date first, because I don't want to accrue any interest with that balance transfer. Does that make sense?
So you're taking the amount from your loan, from the balance transfer, and putting it towards your credit card that's supposed to expire first?
Correct.
Okay. I am not 100% sure on that answer. Is there a certain reason just so that card can stay open longer because it's expiring first, so you're trying to take care of that balance? Is that how kind of like you're strategizing it?
Yes.
Okay. Yeah, let me look into that one for you too. If you have an email or any contact information, I can reach back out to you with that if you want to drop it in the chat box for me.
Okay. I don't know if I know how to do that, but I can get a hold of you at the credit union at Eric's. I'll just tell them that I need to speak with Allie.
Yeah, you can do that, and then I can get your information from you.
Okay, real
And I have
good.
my contact information on the screen here too.
Okay, thank you.
Yeah, you're welcome. Alrighty, that looks like that's about it for today. So again, thank you for joining us. This webinar will be sent to your emails, so keep an eye out for that. And I hope you have a fantastic Wednesday. Thanks for joining, everyone.